Many people are surprised to find out they don't have just one credit score. Credit scores will vary for several reasons, including the company providing the score, the data on which the score is based, and the method of calculating the score. Credit scores are provided by the three major credit bureaus, Equifax, Experian, and TransUnion. May also vary because not all lenders and creditors report information to all three major credit bureaus. While many do, others may report to two, one, or none of them. In addition, the credit scoring model among the three major credit bureaus are different, as well as those used by other companies that provide credit score, such as FICO or Vantage Score. The type of credit scores used by lenders and creditors may vary based on their industry. For example, if you are buying a car, an auto lender may use a credit score that places more emphasis on your payment history when it comes to auto loans. In addition, lenders may also use a blended credit score from the three major credit bureaus. In general, here are the factors considered in credit scoring calculation. Depending on the scoring model used, the weight each factor carries as far as impacting a credit score may vary. So let's break down and see what are the factors that matter. First, payment history. When a lender or creditor looks at your credit report, a key question they are trying to answer is, if I lend this person money, will he or she pay it back on time? One of the things credit bureaus takes into consideration is your payment history, which makes up 35% of your credit score. How you have repaid your credit in the past. Your payment history may include credit cards, retail department store accounts, installment loans, auto loans, student loans, finance company accounts, home equity loans, and mortgage loans. Payment history will also show a lender or creditor details on late or missed payments, bankruptcy, or collection information. Credit scoring models generally look at how late your payments were, how much was owed, and how recently and how often you missed a payment. Your credit history will also detail how many of your credit accounts have been delinquent in relation to all of your accounts on file. So, if you have 10 credit accounts and you have had a late payment on 5 of those accounts, that ratio may impact credit score. Your payment history also includes details on bankruptcy, foreclosures, wage attachments, and ailing accounts that have been reported to collection agencies. The second one is credit utilization ratio, user credit versus available credit. Another factor credit bureaus are looking at is credit card utilization, which makes up 30% of your score. Instead of going out there to max out all your credit cards, the credit bureaus want to see you only use a small amount of what is available to you. In this case, they will know that you are responsibly able to use credit and pay it off regularly. Ideally, you will want to spend within 10% of your credit limit, showing the credit bureau that you don't need all the money the lenders gave you. Let's take this as an example. If your credit limit is $10,000 and you spent $7,000, when the due date came, you just made the minimum payment. So now your credit utilization is $7,000 divided by $10,000 equals 70%, which falls here, below average. When credit bureaus see this, they would consider you have a higher risk with lenders and credit card companies to give money, so they will give you a lower rating. Well, the same credit limit with $10,000 and you spend $7,000. If you paid in full on the due date, your credit utilization is 0%, which falls right here. You definitely will be considered having lower risk by the credit bureaus, so they would give you a higher rating. What we should keep in mind is that when we speak credit usage, it's not all the dollar amount that credit bureaus take into account, but the percentage. For example, If you have a 2,000 credit limit and you spend all of them, now you are maxing out your card. But if you have a 10,000 credit limit and you spend 200, now your credit neutralization is 2%, which is amazing. 3. Length of credit history. This section of your credit history accounts 15% of your credit calculation, and it details how long different credit accounts have been active. Credit score calculation may consider both how long your oldest and most recent accounts have been open. Credit scoring models usually look at the average age of your credit when factoring in credit history. This is why you should consider keeping your accounts open and active. Generally speaking, creditors like to see that you have a history of responsibly paying off your credit accounts. 4. Types of credit used. Credit score calculations may also consider the different types of credit accounts you have, including revolving debt, such as credit cards, and installment loans, such as mortgage, home equity loans, auto loans, student loans, and personal loans. Another factor is how many of each type of accounts you have. Lenders and creditors like to see that you are able to manage multiple accounts of different types, and credit scoring models may reflect this. 5. New credit. Credit score calculation may also consider how many new credit accounts you have opened recently. New accounts may impact the length of your credit history. Hard inquiry occur when lenders and creditors check your credit in response to a credit application. A large number of hard inquiries can impact your credit score. However, if you are shopping for a few auto or mortgage loans or a new utility provider, the multiple inquiries are generally counted as one inquiry for a given period of time. That period of time may vary depending on the credit scoring model, but it's typically from 14 to 15 days. Payment history, credit neutralization, length of your credit history, type of the accounts, and hard inquiries. All these 5 factors determines your FICO score. If you want to improve your credit score, you should work on the 5 factors. In the future videos, I will share with you guys more tips on how to boost your credit scores. Okay guys, this is all for today. I hope you like my video. If you found this video helpful, please drop a like button. If you like my contents, please subscribe my channel for more future videos. I will see you in the next video.